Welcome to Talk Tickers. Today, we are stepping away from the earnings calendars and the guidance updates to look at something much more fundamental. We are looking directly at the plumbing of the stock market. We're talking about short selling.
And not just the standard, I think the stock is overvalued variety. We're digging into the friction points. We're looking at the mechanics of naked short selling, the concept of phantom shares, and the really granular, often controversial machinery that handles trade settlement.
It's a topic that feels like it's constantly bubbling under the surface of, financial Twitter and Reddit. On one side, you have retail investors who are absolutely convinced the game is rigged, that they are buying shares that don't even exist.
And on the other, you have regulators and institutional desks insisting that what looks like manipulation is often just the complex, messy reality of liquidity and settlement.
It's the classic disconnect.
It is. And our job today isn't to pick a team in a moral battle. We want to perform a structural analysis. We need to look at market liquidity, settlement cycles, regulation SHO, and the specific loopholes that exist within the system. We want to understand exactly what happens in the back office after you hit the sell button.
Because when you peel back the layers, this is really a story about promises to pay and whether those promises are actually kept. So let's start at the absolute baseline. Before we get into death spirals or seller boxing, let's get the definition straight. What is the fundamental mechanical difference between a standard legal short sale and a naked short?
It all comes down to one specific critical action, the locate. Yeah. Let's say you are a trader and you think a specific company, let's call it Acme Corp, is going to crash. You want to profit from that decline. To sell shares you don't actually own, the rules say you have to borrow them first.
Right. It's like renting a car before you drive it. You can't just drive a car that isn't on the lot.
Yeah, exactly. In a standard short, you go to a lender, usually a custody bank or a prime brokerage, and you say, I need to borrow 1,000 shares of Acme. They check their inventory, they find the shares, and they lend them to you. Then, and only then, do you sell them into the market. That process of securing the borrow before executing the trade, that is the locate.
So mechanically, when I buy that share from you on the open market, I am buying a real borrowed share that physically or at least electronically exists somewhere in the system.
Correct. You sell the borrowed share, you pocket the cash, and you wait. Your goal is to buy it back later at a lower price, return the share to the lender, and keep the difference as profit. That is a standard, healthy short sale. It aids price discovery.
Okay, so then what is naked shorting?
Naked shorting is selling that share without borrowing it first. You don't locate it. You don't even ensure it can be borrowed. You just hit sell. You take the cash from the buyer, but you have no stock to hand over.
You are selling air. You're selling a promise that you don't have the inventory to back up.
Effectively, yes. And in the settlement system, this creates a specific data point called a failure to deliver, or FTD. The trade executes, the money changes hands, but when the settlement deadline arrives, which historically was T+3, meaning 3 days later, though it's tighter now, the seller fails to deliver the security to the buyer.
Which, to the average person, sounds blatantly illegal. I mean, if I sold you a house, took your money, and then said, whoops, I don't actually own that house, I'm pretty sure I'd be going to prison.
In the real world of physical goods, yes. And generally, in the stock market, it is also illegal. Under SEC regulation SHO, which was adopted back in 2005 specifically to clean this up, you cannot do this intentionally. However, and this is the massive asterisk that drives all the controversy, there are exceptions. The primary exception is for bona fide market makers.
The liquidity providers, the people whose job it is to keep the gears turning.
Right. Market makers have a specific mandate to maintain a fair and orderly market. Imagine you want to buy Apple stock right this second, but nobody keeps an inventory of sellers waiting for you. The market maker steps in and sells it to you to facilitate the trade. The rules allow them to sell that share short without a locate, assuming they will go find the shares shortly after.
And I'm guessing the definition of shortly after is where things get incredibly messy.
That is exactly where the friction lies. How long can they keep that position open? Is it minutes, days, weeks? But before we go down the rabbit hole of loopholes, I want to pivot back to the legitimate side for a second. Because I think there is a misconception that there is just a big pile of unowned stocks sitting at the New York Stock Exchange waiting to be borrowed.
Yeah, let's talk about the plumbing of the borrow. If I want to short a stock, where do those shares actually come from? Who owns them?
It's a massive supply chain. It starts with the lending pool. Think of the biggest investors in the world's state pension funds. BlackRock, Vanguard, massive mutual funds. They hold millions of shares for the long term. They aren't selling them anytime soon. So to make extra money on those idle assets, they lend those shares out.
They aren't doing it out of the kindness of their hearts to help short sellers.
Definitely not. It's a huge revenue stream for them. They lend the shares to custodians, who lend them to prime brokers, who lend them to the hedge funds or short sellers. The borrower has to post collateral, usually 102% of the trade value in cash or treasuries, and they pay a borrow fee.
Is that fee standardized, like a fixed interest rate?
Not at all. It is purely supply and demand. For a blue chip stock like Microsoft or Coca-Cola, there are millions of shares sitting around in pension funds. The fee is tiny, maybe 0.3% annualized. But if everyone hates a stock and wants to short it, the supply in the lending pool dries up. It becomes what we call hard to borrow. The fees can skyrocket.
I remember seeing data on this a few years back. Wasn't there a crazy number for Krispy Kreme at one point?
Yes. There was a time when the annualized cost to borrow Krispy Kreme stock hit 55%.
That is wild. You would have to be incredibly confident the stock is going to zero to pay 55% interest just to hold the bet.
Precisely. That fee acts as a natural throttle. It makes shorting expensive and risky. But, and here's the twist, this whole system relies on the math being clean. It relies on the idea that one share equals one unit of ownership. But there is a famous case study that proves the math can break down in spectacular fashion.
You're talking about the Global Lynx case.
I am. If you want to understand phantom shares, you have to look at the Global Lynx incident.
This story always blows my mind because it sounds impossible. Set the scene for us.
So this involves an entrepreneur named Robert Simpson. This was back in the early 2000s. He wanted to run an experiment on the efficiency of the market and settlement. Global Lynx was a tiny penny stock trading on the OTC bulletin board. Simpson decided to buy the entire company.
When you say the entire company, you don't mean a controlling interest. You mean everything.
I mean every single issued share, 100% of the float. He bought 1,285,050 shares. He paid for them, and he put them in his brokerage account.
Okay, so mathematically, there are 0 shares left in the wild. He owns them all. He isn't selling. The trading volume the next day should be 0.
In a physical system, yes. If I buy all the apples at the grocery store, nobody else can buy an apple. But the very next day, over 37 million shares of Global Lynx traded on the market.
Wait, slow down. He owns 1.2 million shares. He is not selling. And yet 37 million shares change hands. How is that physically possible?
It illustrates what's called the self-replenishing pool theory, or the velocity of lending. When Simpson bought those shares, they were held in a brokerage account. It's highly likely that his broker, or the clearing firm, looked at those shares and said, "Great, we have inventory to lend."
So they lend out his shares without him realizing it.
Often, yes, depending on the account agreement. But here's a kicker. Broker A lends the shares to a short seller. That short seller sells them to a new buyer. Now the new buyer has shares in their account. Their broker sees those shares and says, "Great, inventory," and lends them out again.
It's like Xeroxing the same dollar bill and spinning it 10 times.
It's a daisy chain. One real share can create multiple entitlements or claims of ownership. Everyone looks at their account statement and sees 100 shares of Global Lynx, but there might only be one physical certificate backing a chain of 10 different owners.
So the electronic book entry says, you own this, but the system has diluted the float essentially to infinity.
And think about what that does to price. If supply is theoretically infinite because of aggressive lending or naked shorting, demand can never catch up. The price gets crushed. It destroys the valuation mechanism.
Now, Global Lynx was a penny stock. It's easy for people to dismiss that as, Wild West stuff that happens in the gutter of the market. But this mechanic isn't limited to penny stocks. It played a massive role in the 2008 financial crisis.
It did. We have to talk about the bear raids. This isn't just about small caps. This can take down giants.
This was regarding the collapse of Bear Stearns and Lehman Brothers, right?
Exactly. If you look at the data in the days leading up to the collapse of Bear Stearns, the failed to deliver the FTD rates spiked significantly. There were millions of shares that were sold into the market but never delivered.
And the management at Bear Stearns was screaming about this at the time. I remember them going on TV claiming they were being manipulated into a death spiral.
The death spiral concept is terrifying for a financial firm. Unlike a manufacturing company, banks rely almost entirely on confidence and overnight financing. They need their stock price to be stable, to use it as collateral for their own borrowing. If the stock price plummets, their ability to raise capital vanishes. They become insolvent.
So the argument was, naked short sellers flooded the market with phantom supply, drove the price down artificially, cut off their financing, and killed the bank.
That was the argument.
Is that what actually happened? Or were they just bad businesses holding toxic mortgage assets?
It's nuanced, and that's the frustrating part about financial forensics. Academic analysis suggests that while FTDs did increase, they often lagged behind the negative news. Basically, the sharks started circling because they smelled blood. They didn't necessarily cause the wound. But distinguishing between a fundamental business failure and market manipulation in real time is incredibly difficult.
But the SEC didn't take any chances. They actually reacted to this specifically.
They did. In 2008, in a really unprecedented move, they issued an emergency ban on short-selling financial stocks. They essentially admitted that the unrestricted ability to short naked or otherwise was destabilizing the entire economy. This eventually led to the strengthening of regulation SHO.
What did they change? How did they try to fix the plumbing?
They implemented stricter closeout requirements. Basically, if a stock has a high level of FTDs for 5 consecutive days, it lands on something called the threshold list. Once a stock is on that list, brokers are theoretically forced to close out those positions, meaning they have to go buy back the stock to clean up the books immediately.
I notice you said theoretically.
In finance, enforcement is always the variable. Being on the list should force a buy-in, but as we've seen in recent years, stocks can sit on the threshold list for a long time without a forced resolution.
Which brings us perfectly to the modern era. You cannot talk about short selling without talking about the meme stock phenomenon. GameStop, AMC. The narrative there was purely retail versus Wall Street.
And the smoking gun for that entire movement was one number: short interest.
Right. People saw that 140% of GameStop's float was sold short. The internet exploded. The logic was, how can you sell 140% of something unless you were faking it?
It's a very intuitive question, but based on what we just discussed regarding global links, you can see how it happens legally.
Through that lending velocity.
Exactly. It's rehypothecation. If Fund A lends to Fund B, and Fund B shorts it to Fund C, and Fund C lends it to Fund D, the same share is generating multiple reported short positions. It's a daisy chain of liability. It's incredibly risky, it's unstable, but it can happen legally within the current lending framework. It doesn't automatically prove illegal naked shorting.
But there was another controversy during the GameStop squeeze that I wanted to dig into. The brokers Robinhood specifically halted buying. The conspiracy theory was that they called up their hedge fund buddies and said, hey, we need to stop this squeeze, turn off the buy button.
That is the protection myth. And look, I understand why it looked that way. The optics were terrible. But if you look at the plumbing of the central clearing system, the DPCC, different story emerges.
The DTCC being the entity that actually processes the trades between brokers.
Right. They are the central counterparty. They ensure the system doesn't blow up if a broker fails. Usually the DTCC requires brokers to post a small percentage of cash as margin to cover settlement risk. But GameStop's volatility was exploding. Implied volatility was over 500%.
So the risk of the trade failing went through the roof.
Exactly.
Yeah.
So the DTCC algorithmically raised margin requirements to effectively 100%. For every dollar of stock Robinhood's customers bought, Robinhood had to post $1 of cash collateral to the clearinghouse instantly.
And Robinhood didn't have the cash.
They ran out of balance sheet capital. It wasn't a conspiracy. It was a liquidity crisis at the broker level. They restricted buying not to save a hedge fund, but to stop themselves from going bankrupt because they couldn't make the collateral call.
Though the effect on the price was the same, it killed the momentum.
It absolutely killed the momentum.
Yeah.
But the cause was structural risk management, not a backroom deal.
I want to circle back to something we touched on earlier, the market maker loophole. There is a term that comes up in these deep analytical circles, seller boxing. It sounds like a torture method. What is it?
It's a financial torture method for companies. It brings us back to that exception in regulation SHO for bona fide market making. Remember, market makers can short without a locate to facilitate orders. Critics argue that unscrupulous market makers use this to suppress the price of small cap companies. Imagine a company trading at a fraction of a penny. The market maker can effectively sell unlimited shares at that price to keep a lid on it.
And because they are making a market, they don't have to deliver the shares immediately.
They roll the FTDs. They keep failing to deliver day after day while keeping the bid and ask spread incredibly tight and the supply massive. The stock is boxed in the cellar. the lowest possible price tier. The company can't raise money because their stock is worthless, and eventually they get delisted or go bankrupt.
And here's the dark part. If the company goes bankrupt and the shares are canceled, does the short seller ever have to cover?
That's the jackpot. If the shares are canceled, the short position is never technically closed in the market. They never have to buy back the phantom shares they sold. They keep the cash tax-free or close to it forever.
That is terrifying for a small cap issuer.
Yeah.
But there is a flip side, the buy-in. What happens when the system actually works and forces a short seller to pay up?
This is the risk that keeps short sellers awake at night. If you fail to deliver shares and you end up on that threshold list we mentioned, and enforcement actually kicks in, the broker or the clearinghouse can eventually step in and say, enough.
They take controls.
They execute a forced buy-in. They go into the open market. They buy the shares at whatever the current asking price is to settle the trade, and they charge the short seller for it.
And if the market is illiquid, that forced buying acts like rocket fuel.
It triggers a short squeeze. Forced buying drives the price vertically. As the price rises, other shorts get margin called, and they are forced to buy to cover their losses. It feeds on itself. Since there is no limit to how high a stock can go, the losses for a short seller are theoretically unlimited.
We've all seen the charts where a line goes straight up. That's usually what's happening.
Exactly. It's a mechanical liquidation.
So we've covered the mechanics, the crises, the death spirals, and the seller boxing. For the listener who's maybe looking at a screen right now, seeing high short interest or hearing rumors of naked shorting on a stock they own, what actually matters?
You have to separate noise from signal. High short interest isn't always manipulation. Sometimes it's just a bad company with a failing business model.
That brings us to our one question segment. If our listener is investigating a potential naked short scenario, what is the single most important question they should ask?
The question is the failure to deliver data persistent or transitory?
Break that down. Why is that the smoking gun?
Because high short interest just tells you sentiment, tells you people are betting against the stock. But FTDs tell you about mechanics. If you see FTDs spike for a day or two and then vanish, that's transitory. That's likely just administrative friction or a temporary liquidity gap. Nothing to worry about.
But if it sticks?
If a stock is on the threshold list for weeks, if the FTDs are persistent and growing, that suggests a structural breakdown. It means there is a settlement issue. It implies potential phantom supply or a liquidity crisis that goes way beyond just bearish sentiment. That is where the smoke is.
It's the difference between a disagreement on value and a broken market.
Exactly.
So to wrap this up, short selling is a legitimate part of the ecosystem. It aids price discovery. It dampens irrational exuberance. But the plumbing it relies on isn't perfect.
It relies on fungibility. The idea that any share is as good as another. And that fungibility, combined with the complex lending chain, can create phantom supply. While naked shorting is technically illegal for most participants, the complexity of the netting systems and the market maker exceptions make it incredibly difficult to detect in real time.
And as we saw with GameStop, even the safeguards like margin requirements can have massive unintended consequences on whether you or I can even buy a stock.
It's a reminder that when you buy a stock, you aren't just buying a piece of a company. You are entering a complex web of counterparty risk.
A sobering thought to end on. Don't just check the price action, check the settlement data. That's it for this deep dive into the mechanics of short selling. Thanks for listening to Talk Tickers.
Always a pleasure.
We'll catch you on the next one.